Hi friends, welcome back. I'm about to start the Bitcoin episode. I forget to talk about the monthly time frame. I talk about the monthly time frame for Bitcoin at the end of the Ethereum episode, so be sure to tune in for that because that's worth looking at. And if I don't appear in this video because the camera didn't work or whatever, no big deal. My audio is still available, and really whatever, it's no big deal. I'll catch you in the next episode, and thanks for tuning in. Hello friends, welcome back for Bitcoin Technical Analysis with me, your friend Rocky Outcrop, and in this episode we will be talking about all sorts of glorious, wonderful things and going completely crazy and absolutely FOMO mad, and greed and fear will be ripe and everywhere. Absolutely not. In fact, it'll be the opposite of that, and we'll just try and keep our heads screwed on, shall we? How about that? That'll be a bit of fun, a bit different. Maybe I will have a different video for you to watch today compared to the rest of YouTube. Who knows? Thanks so much for joining me. There's a link in the description to a Discord channel you can join. You can hit subscribe or whatever as well, because we do these videos every single day. And you can also leave comments down below as well. I read all the comments and all that stuff, so I really love it. Right, actually though, word of warning, if you do follow me on Twitter and you see me saying something like the RSI was developed in 1912 by Bert Longerfield after having fell over a stone in a field and picked it, it's probably some made up joke that I'm putting out there, I tend not to do, I'm not a signals guy, I won't put any of that out there, and I don't, and if I'm saying something, I use a lot of satire and irony, just, try not to read me literally. Anyway, okay, here we go. What have we got at the minute on the go? I've got the 2-day chart up behind me. I'm starting off on the 2-day chart here today because it's a little bit less divergent. Well, it's interesting to look at it. What have we got right now? We've got a doji here. We've got a doji. There's a whole day and 11 hours left on this 2-day candle, of course, but we've got a doji here at the minute, and we've had this high so far up here of 9,500 or so, and this low so far of 8,500 or so, and that's the same on the daily chart. Spoiler alert. Same in the daily chart. We've had $1,000 price action today alone, so that's crazy. A lot of trading to be had out there, and of course that could be. And you can remain agnostic about this. Of course, if you're smart about things, you can find it very easy to capitalize on lots of short entry and things like that over the last wee while. I'm not a financial advisor, none of this financial advice. And if you sort of just, if you just held your position from any time over the last month or two, then hey, you're in profit. Anytime since the March the 13th, then hey, you're in profit, and you could sort of just be ignorant about things and not even do any technical analysis and still be making money. So that's great. Everyone's a winner, right? So what have we had today then, or what have we got at the minute? Sorry, in terms of the last couple of highs. This is the high here, and this is the previous high over on the 2-day chart, and you can see this is where as high as the RSI got, and then the latest news is that the RSI is higher, so that's not divergent, it's bullishly convergent, you could say. Likewise with the stochastics and the DMI and the MACD down below, so there's no divergence there on the 2-day chart. Isn't that groovy? Of course, we're still looking at this and asking the questions like, will we get a higher low in here at any point? Over the last wee while, it's just been up only, and that is unsustainable on the longer term. Let's just jump down to the 24-hour time frame and take a wee look-see though, where things are a little bit more spread out by a factor of 2, obviously, and see if there's anything. Now, obviously, you can see the RSI just is clearly not divergent, and you can see the DMI is clearly not divergent as well. Just starting off over here, if there was one sort of question mark when it's all smushed down, it'd be this here on the stochastics. But you can see as I make it bigger that it's clearly also not divergent. In fact, if you want to look back the way between the previous one, you're going back to February the 9th there for when the stochastics got even quite as high as this. So in some senses, if you want to look at a bearish type thing about it, we've come up to very, very highs. The only back at our previous high, and they turned around a wee bit. So there's a slight note for concern. Indeed, on the 2-day time frame, you can see that it's a similar situation. We didn't get as high as we did over there on the sort of the peaks of the market at 10th of February. We're only really as high as we were back there the 19th of January. So in terms of looking back, in terms of can we keep going, and in this area like here, in this area here, can we keep going and continue to be in the over so-called overbought zone? Yes, you can. And what happens? What actually is the story here? Well, you know, this area here is the very, very bullish zone as well. Overbought's a bit of a misnomer, and of course you can see the prices stay in this area and continue to do all that jazz over the next wee while. So, you know, but there is the sort of the somewhat bearish supposition to put out there when it comes to being in the oversold or overbought, or, you know, these extended areas, that you know, what goes up must come down or whatever. So worth throwing that out there for people to be aware of. Now though, looking at the that's the back on the 2-day again, sorry. On the 24-hour chart though, you can see on the daily time frame that between this high here and this high over here, that they are actually bearishly divergent. And kind of in a sense that makes sense, because, you know, we've got this overall rising wedge formation, potentially, or channel. Let me just stick it on logarithmic so it looks a little bit more wedgy for a second. You know, this potential wedge or this channel or whatever. And I'll just remove that from the chart actually just now. I will discuss that in a bit more detail, and it'll involve me drawing on that lower line again in a moment or two. But yeah, so anyway, are we divergent between these two areas? Well, we are on the MACD, but we aren't on anything else. And the ADX has just moved above the 20 area over here, indicating that we have some upward side strength trend, you know, as these things continue to diverge. And like I say, you know, we're in that zone, which is called, which is perhaps a misnomer to say that it's overbought and whatever else. So, you know, there's those elements there when it comes to that. And then just looking down the time frame, starting off here, kind of today's episode, looking for the old divergences. RSI not so much, of course, and that's better for the trend than this one, than the stochastics, which is better for oscillating price action or whatever. But you can see as well that it's not divergent either, with this high having come in higher recently. The DMI likewise, and the MACD again becomes, it's not divergent again really either between this high and our previous high. So, you know, that's interesting. So you can see a touch of it on the 24-hour time frame. The 2-day and the 12-hour though are sort of getting rid of that and smoothing that away for us. So that's interesting as well. Looking at it in terms of, yeah, so that's enough in terms of price, in terms of oscillators down below for today's episode. In terms of the neutral case especially, I think we've kind of summed things up there. Things overall have been bullish with the price action, whatever else. There isn't a massive, you know, scary level of divergence there to be really aware of. There is some on some time frames, like the 24-hour with the MACD. Yes, there is some. What could we else be looking out for though in terms of this sort of thing is we have to actually look a bit further back in time to find out if we've got divergence coming in here. And if you look, actually go up to the 2-day time frame, you can see that we'll not get any sort of divergence on this 2-day time frame in terms of hidden divergence, just where we are right now. Going down a time frame to the 24-hour chart, and questions could start to be asked should the prices go any higher. This is our previous high over here in February, and RSI is coming in here and just as the same sort of height as what it was before. So should we see a local high coming in here and not be any higher than the previous price action over in Valentine's Day at 10,500, we don't make it up and sustain it up, that price action up there in those levels, you'd have hidden bearish divergence on the go, and that would be you know, as part of a potential downward trend, because this would be your low and this would be a higher low, and you'd be asking questions, will we see a lower low come in thereafter with that hidden bearish divergence? There you go, that's the neutral aspect of it. You know, this likewise as well here on the 24-hour time frame, you've got the recent divergence of the MACD, but looking back to where it was over here, it's not divergent versus the, it's also got that hidden bearish divergence on it. All of the oscillators would have that potentially. Let me just see with the stochastics. It's so close, but it doesn't quite have it on the stochastics quite yet, you know, or whatever. But we can look out for that on the way up towards 10,000 if we get hidden bearish divergence, if that happens as part of this upward trend that we've got on the go at the minute. Let's get rid of that now then and just look at the price action in and of itself and just say, look, where are we right now? What have we done? Well, we've come up to this area where we've got a sort of supply zone, you could say. Supply zones, by the way, are just a vague a nothing concept really from trading, where you look and say, look, there's previous price action over here, and you could draw it in. Same thing actually happens where you would have, if you look at how there was trading in here and here and here and here or whatever, then you have the VPVR drawn on or whatever. You know that there's going to be nodes in this area because of the past stuff like that anyway. In fact, screw it, let's just ditch the MACD for now. Stick the VPVR on. Right, okay, so we've got the VPVR on. It took a minute there, and you can see that just in this area here, going to the left, that there, of course, there's more nodes here, there are bigger nodes here than just above, just above that, or just indeed below it. We know that this area here potentially would have been one, and it took me like a few minutes to get that indicator to show up, and I'm not sure it was actually worth the effort. Anyhow, going back down to what we've been looking at here, just this general area. So, we've got this uptake in the VPVR here, just like we thought we would, or whatever, where there's a supply zone, you could say. And so, of course, we can anticipate there being some sort of degree of resistance in and around the 9,000 price point. Now, what's happened with the prices actually, they've gone up as high as 9,500, which is above the 786 over there, and they've dropped back down again to as low as 8,515. In terms of just looking at, in terms of retracements and whatnot, Fibonacci retracement on here, do it body to body just for the crack. Right now, you'll be looking at the prices coming down to 7,899. Do it wick to wick instead, and you look at the prices coming down as far as 8,144, and you've got a 236 retrace there for you, just in terms of the, speculatively looking at this just now, and for future knowledge. So that's good to know. We can bear that in mind as well. Anyway, if we come back down to between these sort of 2618 retracement areas on this Fibonacci retracement we've got in from the Valentine's Day to Friday the 13th, and we know that that's a danger area for us in terms of a 236 Fibonacci retracement. In terms of if we did go in and put in higher low, what could we be looking at if we just stick the moving averages back on? So we can see, if we've got the 200 simple coming in here at 8,000 as well, and so you'd want to see that as support ideally. If the prices didn't get supported there and we were back into this area, by the way, that would be kind of negative. We'll talk about that again in a minute here or two. But next, if you want to see your higher high, your higher low, excuse me, considering that this potentially isn't your previous low, which it doesn't look like, coming in, if you think this was the low here back on the 28th of April or whatever, and it show up as being a sort of low on the 4-hour time frame or something, then you're looking towards 7,600 or so. But you could actually have on the daily time frame a higher low come in anywhere far down as 6,850, which we've spoken about numerous times before. And I know that seems so crazy whenever you look at it as being almost $3,000 down from where we've had our highs today, and that seems and feels so crazy or whatever, but that is the reality of it. Now, that could happen. If that were to happen, various other little things would be, you'd have to consider what was going on there and or whatever. But first off, just in terms of measuring down from our highs, in terms of is it a correction? Well, is the 200 simples 15% down? Your previous high, your low, if that's what you think of it back there on the 28th of April, is near enough 20% down, 18 to 20%. The horizontal line that we have in here at 7,450, which we've spoken about enough times recently, is a 20% correction. You're in correction territory at that point. You have to sort of think, and then if you did go down to sit in a higher low and you remained bullish on it or whatever, which you theoretically could do, would be all the way down there at 27% retracement, all the way down to 6,850, and that seems rather grotesque, really, but and I would say there's a lot of price action and trading to be had in the meantime, but you'll find people out there in the world who are like, the sort of perma bulls, that's how they would maintain their stance on the way up to that. What have we got here is this potential channel that we've been talking about quite a bit recently, and you can see that it fits all well enough, whatever, and that the prices, if they come down below 8,600, 8,750 actually, then you're looking at the prices being back inside this channel again, which is kind of like a bearish thing in a way, because that's a fake out from the channel and whatever else. But you could remain bullish in the face of that. But you'd also be breaking down below this node here, the 8,750 area on the price action, and going back into danger territory, where you could see the prices rapidly slope down, and then again the story of the 200 simple kicks back in again. What else though is there is this other chat to be had. Pardon me. I'm going to put this on log for a second, just so that the bars up here are relatively smaller than the bars down here than they would be on linear, just so that I can draw this in, draw this wedge in, looking even more wedgy or whatever. There are a couple of different ways you could draw this. Obviously, you get 3 touches there, for instance, and whatever. Let's not split hairs about things. And you could say that there's this wedge here, and perhaps you've got a breakout towards the top side. Great. Okay, so let's just consider, like, if you had a breakout slash versus fake out towards the top side, what could that look like? And if we do a measurement off the back of this wedge, just roughly, and talk about how you could have that. Now, textbooks talk about these things as being minimum moves. We talk about them on the channel as being maximum moves because it's better for managing your risk and FOMO and everything else. But you'll be looking up there towards 10,000, okay, in terms of that move. And we didn't make it up as high as that. In fact, we only made it up as high as the sort of 9,500 area, you know, and there isn't very many other sort of selfish ways of positioning that measured move thing to get it so that that satisfies that measured move in some way. And like I say, the textbooks call them minimum anyway. So you could be looking at this and asking, is that a fake out? And if that were, if we did come back into this area, we're back inside the wedge again, then you'd have a fake out towards the top side followed up by potentially coming down and testing off the lower side of that wedge again if you were to go to 200, okay? Now, at the point at which you go down and test the other things we proposed a minute ago, such as maybe the 21 EMA, your 50% retrace, I didn't mention those two, but they're in there, or this horizontal line at 7450, which is where previous highs were, indeed, or whatever, then you're talking about being in sort of fake out territory towards the downside, as we've seen up here towards the upside, okay? And then at that point as well, of course, fake out territory becomes the channel. We speak about this all the time on the channel, how, you know, fake outs from wedges form channels and stuff like that. In fact, quite often full measured moves from fake wedges form channels, blah, blah, blah. We don't really care. We know that there's a dynamic there. We've explored it enough on the channel. Subscribe, by the way, for daily videos. But you'd be down there towards the bottom of the channel. But anyway, if you were to then actually get the full measured move off of this thing, like, you know, or whatever again, and it was to go towards the downside, you'd be looking down here towards where exactly at the point of control is, just where I have the screen now. Of course, this will change. It changes actually, but it just coincidentally where I had it there, it was where that line was coming in at. It's also where the 50 simple moving average is coming in at. And I hate the point of control being on this thing, actually, so I'm just going to get rid of it right now. There. And you'd be looking at that and asking a question about it as well. So, like, could you know, and that would be obviously quite bearish at those points. Now, there's something else to be pointed out here, and I'll just take a bit of free space to do it. And if you watch if you watch a YouTuber out there who's got over 100,000 subscribers, who I've got a great deal of respect for, by the way, I think he's a really nice guy, young, intelligent, English isn't his first language, whatever, and he talks about Bitcoin all the time, and he's in that sort of thing, and I think he's done a lot of good work in the world. So you might know who I'm talking about, but I don't like to name names on the channel or whatever, at least not just now. He often talks about how if you've got a wedge on the go, and he loves to talk about, you know, falling wedges because they're typically, you know, statistically lean to the bullish side pattern, and that he talks about how this concept of a dip outside of the pattern, okay? He talks about a dip outside of it, where you could get maybe a fake out down below. Say the price size came down here inside of a falling wedge, came down below here, then came back into the wedge. He calls that very bullish, you know, and it's true, whatever. It's a thing from charting. And then you could maybe get an even stronger move off the back of it the other direction, having had this happen up here. Various reasons for that, if you think about it yourself, in terms of like liquidity and stuff like that, and, you know, and like stop hunts and whatever else. There's hundreds of reasons why that could be the case. But just want to point out then, in terms of, you know, we want to be neutral on this channel all the time and all the rest of it. So how would that function? You know, what would we be looking at there, and to be aware of should that be the case? Of course, is that you'd have had a wedge towards the upside with this price action wedging up the way, and then you'd have had what you could have said was maybe a fake out there, this sort of so-called dip. Obviously, dip, whenever you're going up the way, dipping out of a thingy, is sort of, I don't know, what would you call that then, a flip. And then if you came back into the bottom side and then broke down towards the downside, then you're looking at doing it with increased momentum and all the rest of it, and that could even be worse, you know. So there's your neutral case scenario as well, in terms of that. But we know that you'd have it all be telegraphed. You'd know about it in advance, because you'd be breaking down past certain levels on the way. We've discussed the divergences as well. Only things really left to discuss on here are things along the lines of, like, you know, as we talked about so many times, can we get sort of confirmation, so to speak, confirmation volume on, is this it? Yeah, on this bump and run reversal pattern. Well, we've got the volume here to go along with it finally after you know, all this move, so we could say that maybe this pattern is happening. You could. What sort of things can you do for measured moves off these, actually? Can I remember exactly what the measured move is supposed to be off the top of my head? Give me a minute, I'll come back with the answer for us. That took ages. Sorry. So average rise. Bukowski says use this thing as an encyclopedia, so I thought it would. 38% is what it says in terms of the average rise. Where do you want to measure that in from? Let's do it from there. We've had 44%. The prices have moved up currently where they are 31%. So the average rise is about 38% in there. You could say that we just completed this pattern in terms of its usefulness. Of course, we've only just got this coming in now. I would like to say that overall, you could actually look back towards the textbook and say that like this here looks like a lot more than a 38% move towards the upside. What's the prices there? 11, then they go up to 28. You're talking hundreds of percent there. So really, average rise, whatever. This one here is an example of the 350% rise. Actually, as it happens. So there's not, so like to say that there's a sort of that it's done. Well, it's not. You couldn't say that the textbook says it's done, or whatever. But you can say that it's had its average rise off the back of it. And it doesn't need to go any further for us to be able to say, well, this was a thing and it happened and it's done now. So overall, so like if you want to start sort of again, just at the point where you're able to say like we've got sort of somewhat the rise in volume that we're looking for in this area, and it's just kind of sort of has it met its minimum requirements for as a play out for it to be considered successful in terms of the textbook? Well, it has actually, incidentally. But again, this is actually a bullish pattern, and you could see prices go up further overall. In fact, higher than the potential than the lead-in phase of the price action. Let's just see compared to the lead-in phase. Is that where you measure it from? No, it's from the lows. Anyway, so yeah, we've not even made it past the lead-in phase yet, so I wouldn't say that it's done. It's because of the shock and because of the way that this isn't like a perfect one of these things anyway. It never has been, and it won't ever be. It's obviously very memey, and there's actually different reasons for why the market's gone bullish than as opposed to this line here, and that's just the reality of it. But whatever. Yeah, we've not even gone past all these other points over here where we're at before 10,500. If we saw a 30% increase in prices from just compared to our previous part in the high of the lead-in phase, which is not where the measure's done from, you'd be looking up towards the 1618 Fibonacci retracement up there at 13,799, or whatever for that, and that could be a target for people. Okay, if you want to do that, if you want to say that that's a target, then it could be. I don't think that actually enables or helps or whatever facilitates trading at all, really, in the reality of things, and all that. Current prices now are 8,878 or so. So the price action has moved a bit, or whatever in the meantime, but where are we right now in terms of CMEs, where we're back inside this area that we defined as being where the gap was? It came all the way down and tested to 200 simple, just as Peter and I talked about on Twitter yesterday. Hello, Peter. Happening at the time or whatever, chin chin, we gave him a cheers there at the time we were talking about it. So that happened exactly as he suggested it would, and then the prices have come back up and to where we find them now at 8,950. Well, there's decision making area to be in and around this price point, and the 786 reversal area, if we were to have one, is in there as well. So I think that again, I still think that the bullish case continues to speak for itself. If one thing is alone is like we're in an uptrend from well, it's an uptrend, as it said in reminiscences of a stock market operator. So we're in an uptrend, and an uptrend's an uptrend, all that good stuff, and that's the case. But there's various areas along the way that have been touched. We don't have the divergence that you would need to see necessarily to say yes, things are very scary right now, let's get in there and short this out of this. But we do have areas that we can look to go alongside certain things that would complement the wee touches of divergence. I've taken the MACD off, I forgot that you have, for instance, that you have on the MACD, or indeed that could just go along with the idea of being in a sort of very extended overbought position up here on the stochastics, which is back where our previous highs was. But of course as well, there's the counter argument to that where we indeed continue to stay in there, and how I call it the very bullish zone as opposed to the extremely bullish zone. When things are extremely bullish, the likelihood is that it'll become less bullish. That's extreme, or whatever. But I don't like to call it overbought. Whatever, I don't care though. And you could look towards this as well and say in the RSI that in terms of the overall trend, that you've got hidden bearish divergence should the prices actually top out there, go along for a local top, especially if the RSI goes up any higher than it is now and then comes back down into this area where we'd have both first the wedge, then the fake out of the wedge, which is the channel, then the breakout of the wedge, which is the breakout of the channel incidentally as well, and you'd be looking towards, for instance, where this bump and run reversal line is and where the 50 simple is and all that sort of stuff. And I hope that the episode fits together well enough. Hope that's enough of a summary and whatever. And and I'll chat to you in the next episode. Unfortunately, I recorded this earlier and it didn't work and whatever, and I had to restart it again. And I'm not quite sure if I've mentioned everything or not or whatever. But catch you in the next episode. Oh, and tune in for the Tezos episode as well if you're interested in seeing me explain a little bit more detail what divergence is. I think I'll probably talk about it there. I don't really know. Join the Discord down below and leave me a comment, say hello, like, subscribe, all that jazz. Thanks so much for tuning in. Of course, the summation is that yay, bullish stuff, but then here's what could be working against it if you want to know those things. Hopefully pointed out one or two things that you might not have noticed otherwise. I don't know. Catch you next episode.